Hello friends, this is Sushil. Welcome to my presentation on equity investment. I had entered in equity investment 7 years back, but it took more than 2 years to decide whether I should enter into equity investment or not. I was never interested in equity market, and I had some assumptions regarding stock market investment. To me it was like gambling, uh, or else like majority lose money in market, and you have to be financially educated to invest in market. These were my assumptions. So I thought, let me keep myself away from market. But the person who directed me in equity investment was highly credible. He had seen multiple ups and downs of market. He learned a lot from market. In fact, he is not really a person who is having sound knowledge in stock market investment. He was uh, having overall understanding of finance and other assets. uh, but still, I felt there are few questions for which I should get answers before entering into market. So these questions were, what is equity investment, why one should invest in equity, why majority of the people are failing in market, how one should invest in equity market. So we will try to understand answers to these questions in the presentation. Whenever I get a call from my relatives or friends regarding equity investment, I used to ask what is their perception about equity investment. And majority of them, they look for short-term gratification. They ask me, how we can generate monthly income using equity investment, or else, can I put some money and make some immediate money within 15 days, whether such opportunities are available or not. So their philosophy is completely based on trading. And 90 percentage of, or not even 90, more than 90-95% of the participants in the market, they are traders. Now that's the only reason for market to be highly efficient for these many years, because market is much more efficient than traders. That's a reason it survived for so long. So here we will be discussing about investment. It is purely long-term investment. So wherein one has to invest money, wait for a long period for rewards, and the reward will be substantially huge. Okay, now we will move to the next slide. So let us understand what is equity. See, an investor treats stock as a portion of business, or it's an ownership in business. Now imagine, if you're planning to purchase a house, how much due diligence we will do. We will look for the location, we will look for credibility of the builder, facilities provided, so vastu, all those small things, we will examine before purchasing the house. Similarly, when we are purchasing a business, we have to check, the fundamentals of the business, the product and services provided by the company, management credibility, their performance in the past, what all are the risk, what could be the growth rate, whether company has got enough tailwind so that it can perform in future. So we have to look into all these parameters first. So, and once these parameters are assessed, the second most important criteria is to purchase this portion of business at a discounted price. So the investor has two major roles. One is to identify a good company with future growth potential run by great management. And second is to purchase this business at a discounted price. Now, let us hear it from the master Warren Buffett, his philosophy about stock market investment.
Well, if they just think of stocks as pieces of business, they'd be so much better off than thinking of them as little things that move around in price. And I think with Berkshire, we have an unusual number of people as shareholders who just look at Berkshire as a business. They look at it as a
So, we have to consider stock as a piece of business. Having understood the concept of good business and purchasing it at discounted price, let us now try to understand how we can execute this philosophy in market. Now, one thing what we have to understand, stock market is volatile. And what is volatility? Volatility is the gap between price and the value of the business. It swings in either direction based on the collective emotions of participants. So we will move to the next slide to understand how it works. There is a quote by Philip Fisher, which is my favorite. The quote is like this: price is what you pay and value is what you get. Here, the price is the price what we pay for the business, and value is the underlying value of business. Okay, now the future value of every investment is a function of its present price. Okay, the higher the price you pay, lower will be the return. So, if you read Intelligent Investor, Benjamin Graham, the father of investment, had given so much importance to this principle. In fact, he defined a new term for this scenario, which is called margin of safety. Okay, now what is margin of safety? So, margin of safety is a scenario or condition when value of business is substantially higher than the price. Okay, now this is the principle or theory what uh, any investor should follow in the investment. Okay, he has to look for margin of safety. Okay, and when the margin of safety is higher, that is the time he should put his money for investment. Now we know that in market is volatile, so price continuously change based on market condition. Price moves up with greed, overconfidence, and optimism. And when these emotions peaks, it eventually creates bull market. Now, this could be the best time for investor to sell his stock because there is no margin of safety. Price has substantially gone up than the value, and this is where he can make huge profit. On the other side, when emotions like pessimism, fear, panic, if it is driving the market, you can see that price continuously falls. Okay, and when it peaks, it creates a bear market. Now, this is the best time to buy. Okay, so investor, in addition to this, they also get opportunities specific to certain business when there are small problems which are solvable. Okay, so what uh, we can get from this slide is an investor, you know, has to continuously look for business with high margin of safety and bet heavily whenever we get such opportunities. Okay, and when the price substantially goes up, considering the value of the business, that is time to exit from the stock, or else that is the time to profit from the stock. Now we will move to the next slide. Okay, so this slide is about why one should invest in stock market. So the first point is market beats inflation. Now, this is a very important point, because how we interpret, this statement is very important. If you're simply going and picking some stock, it's not necessary that that will beat inflation, and tomorrow you may lose your money. So usually this statement is always connected to index. Okay, worldwide, let's say if you look at S&P index in US, or else let's say in India, if you look at Nifty, So in 1990, Nifty was at 279, and today it is at 10,700. So even if you consider this value, the peak was somewhere around 12,500. Okay, so even you consider the current value of 10,700, the compounding rate is somewhere close to 12 percentage. And if you consider 12,500, this is it is close to 14 percentage. So this is the best compounding rate in any asset class what you can get. Okay, now because why I'm saying is this compounding rate is applicable for 30 years, which is very difficult to achieve. So next point is, equity investment is tax efficient. So there is long term capital gain and short term capital gain. So we will discuss only long term capital gain. Why? Because we are not trading here. So the long term capital gain what we are going to pay is only 10 percentage, and that is also only recently implemented. It can be easily liquidated, unlike real estate, and it is the best compounding machine considering any other asset class which we have already discussed. Market is a reflection of how world is progressing. Okay, as investors we are optimistic about world, and I think this is like one big mindset what we need. We have to be optimistic about how world is, because market has faced and survived multiple wars, pandemic breakouts, and economic recessions. Okay, we are continuously evolving and making things more and more efficient, and we believe human race will evolve and will make things better, and that is what eventually will get reflected in market as well. So I will now conclude this presentation with the major points what we have learned. Equity is portion of business or ownership in business. Understand business before investing in stock market, which is very very important. Check for margin of safety. Take advantage from market emotions to sell and buy stocks. Investment in index fund is simple and it will beat inflation. We are optimistic about the world and we believe that it will be a better place. Don't trade, go for long term investment. If you trade, the probability of losing money is much higher, and that is why market is more efficient. You have to be a learning machine to eventually become a good investor. Okay, and there are few more important points, because people simply jump into market, invest their money, because this is hard earned money, so we have to think about certain more points. Before entering into market, make sure you have medical and term insurance, because people don't prioritize these things. Okay, you make sure that you are having your running income as well as you have emergency fund. When I say emergency fund, at least you should have the liquidity for 6 months. Okay, don't deploy funds you need within 3 to 5 years in equity. So friends, thanks for watching my presentation. I'll come with more presentation on equity investment. Wish you good luck. Thanks a lot.